Another advantage of the gold standard is that it has an inbuilt price control mechanism. And we're going to illustrate this with an example. So first, I'm just going to make this thing disappear. So let's assume that people in country A and country B both like eating burgers, and burgers are manufactured in both countries. In country A, burgers are manufactured and sold, we're going to assume, for a price of one country A dollar. This is the price. And this is equivalent to 1 gram of gold because of this exchange rate over here. In country B, they also make burgers, but the burgers aren't the same as country A burgers. They're a little bit different, but the price is equivalent, meaning that they each cost 2 country B dollars, which is equivalent to 1 gram of gold. Now, because these country A and country B burgers are slightly different, it makes sense for both countries to import and export their burgers, as in there's demand for each country's burgers in the other country, because they're a little bit different and people have different tastes. So what this means is that every year we're going to assume that country A sends over to country B 5 burgers. The A means are country A burgers, and country B sends back the equivalent amount in gold, which is equal to 5 grams of gold. And we're also going to assume that country B exports to country A 5 country B burgers. And country A sends back to country B the equivalent amount in gold, which is also 5 grams of gold, because each burger, again, costs 1 gram. So now, as you can see, what this shows is that there's no trade imbalance between the two countries, meaning the amount of gold that's entering country A, 5 grams over here, is the same as the amount of gold that's leaving country A, again 5 grams of gold. So I'm going to write over here that the trade imbalance is equal to 0. Now let's assume that suddenly country A figures out, because they have some advanced technological breakthrough, they figure out some way to make the same country A burgers for half the price. So the new price is equal to half a country A dollar, which is equal to half a gram of gold. And because the price of burgers went down, that means that the general price level in country A went down. So I'm going to write that over here. The price level decreased. Now, what's likely to happen is that people in country A will say, wow, this is incredible. I can now get the same country A burgers for half the price. And they'll probably also think, wait a second, do I really want to eat country B burgers? I mean, they're almost the same as country A burgers, but they're not worth twice as much. So what you might expect to happen is that people from country A will cut back from importing country B burgers. So what we're going to assume happens is that they completely stop importing country B burgers. And so the number of burgers imported from country B goes to 0. And because now there's no reason to send gold back to country B, this number over here, the amount of gold sent to country B, goes to 0 as well. And now if you're sitting in country B, you might be thinking, wow, I can now buy these country A burgers for half the price, because people will import them to country B and sell them for less money. And because of that, they might be thinking, wow, I like country B burgers, but they're not worth twice as much. I'm just going to shift my diet entirely to country A burgers. And so what you might expect to see is that imports of country A burgers to country B will probably go up. And we're going to assume that they go up to 10 burgers a year. And so country B will have to send to country A the equivalent amount in gold. So that's 10 burgers times the price in gold, which is now half a gram of gold each. And that's still equal to 5 grams of gold. So that this number over here, the amount of gold sent back to country A, stays the same. But you'll now notice that there's a trade imbalance. Because country A isn't sending any gold to country B, and country B is still sending over 5 grams of gold to country A, there's now a trade imbalance of 5 grams of gold. So this number over here, the imbalance, changes to 5 grams of gold. But what does this mean for country A? Now in country A, whoever will get this extra gold will likely deposit it at the central bank. And so the central bank will see its gold reserves go up by 5 grams of gold. So in this case, it will go from 100 to 105 grams. This number will increase to 105 grams because of this extra 5 grams of gold. And because of that, if the banks try to keep this ratio of money supply to gold constant, that implies that the money supply will change. What will the money supply be? It'll be 105 grams of gold times the exchange rate times this ratio over here, which is 1,050 in money supply. So the money supply just went up by 50. Now, if we assume that this increase in money supply doesn't come with a corresponding increase in the amount of goods and services that country A produces, then you might expect that you have more money in the economy that's chasing the same goods and services. And so what you might expect to happen, and what's very likely to happen, is that the general price level in country A will go up because of this increased money supply. So let's step back and let's re-examine what just happened. Because of a technological innovation in country A, they were able to make burgers at a cheaper price. And this caused the price level in country A to go down. And this decrease in the price level, because of the gold standard, led to a chain of events that eventually caused the price level to increase such that it went back relatively in line with what it was before. The chain of events that led back to the stabilization of prices was through the trade imbalance. Because of the decreased prices, there were increased imports of country A burgers to country B, and this caused gold to flow to country A, which caused the central bank reserves of gold to increase, which eventually caused the money supply to increase, which in turn caused the price level to increase. Now the opposite will happen to country B, as in because there is gold flowing from country B to country A, now country B will have less in its gold reserves. So it'll, instead of having 200 grams of gold, country B will now have 195 grams of gold, so 200 minus 5. And this will imply a money supply of 195 times 2 times 10, which is 3,900. And so the money supply in country B has decreased from 4,000 to 3,900 because of this outflow or this trade imbalance of 5 grams of gold. And this decrease in the money supply, all else being equal, will create a decrease in the price level. And this decreasing price level in country B, in conjunction with the increasing price level in country A, will make it such that the price levels in the two countries are relatively in line. And so in the big picture, what's happening is that the amount of gold in country A plus the amount of gold in country B is always fixed. It's always constant. The only thing that's happening is that because country A is now better at producing burgers than country B, more gold will flow to country A. And so in some sense, country A will become a wealthier country than country B because of their technological innovation and because they're able to produce burgers better. And so the really important point here is because the amount of gold in this entire system, the entire system being defined as country A plus country B, because the amount of gold in that system is fixed, that implies that the money supply in that entire system is also fixed. And that the money supply or the gold is simply transferred to the countries that tend to be better at producing things. But since the money supply in the entire system is fixed, it implies that the price level in the entire system tends to be relatively constant. And so if you look at the inflation rate in the gold standard countries from really the heyday of the gold standard from about 1870 to about 1913, so if you look at the inflation rate at that time, it was 0.1%, which is pretty low. And so basically, while it existed, the gold standard did a very good job of keeping the long-term price level between countries relatively constant.